I wouldn't denigrate this office with subpar closing rack.
No, not when there's so much to be complimented.
I feel attacked and seen.
Attacked and
I
seen.
feel this is a natural state of being for Alex Watson. I like it. Yep. Goodness. Let's get into this. G'day, ladies and gentlemen. Welcome to Finance But Neat, the home of fishing for a reaction and indulging in a potentially aggressive, maybe too aggressive rant. Welcome to Alex Watson's life. This is your story. Oh, man, I wish.
Yeah. You do great on that show.
Oh, I would love it so much.
Yeah.
There's a lot of family history to dig into.
Yeah, I know.
Yeah.
I'm learning more and more all the time.
Oh, goodness.
But do you know what a Henry is?
I don't, Bindi Holland.
You don't? Okay. You said something earlier in the week, and I keep thinking about it. It's been playing on my mind. You said that one of your biggest fears is that you're going to get to retirement age, you're going to be reflecting on the story so far, you're going to be looking at all of the, the brilliant things that you've done with funded finance. But one of your biggest fears is that you will have just used it as a source of income. You won't have actually done anything, have anything to show for it. And then I heard, after that conversation, I actually heard this word Henry.
Not the octopus?
Not the octopus,
okay.
But really describes exactly what you were talking about. It's an acronym. It stands for High Earner, Not Rich Yet. Yeah. So the thing about a Henry is that it's not a lack of income, it's not a lack of opportunity, it's actually a lack of wealth creation.
Yeah.
Like you're not doing something with what you've got, if that makes sense.
Yeah, definitely. I love that.
Yeah, I thought you would.
Yeah, I really do. I am weirdly intentional, I think. The reason I am so intentional is because I can be so impulsive that I need to be able to have certain actions that are consistent, repetitive, to create things that allow me to be impulsive constructively and not just impulsive destructively.
Yeah, because that could get out of hand.
It does get out of hand. It's not could.
Even
it does.
Even with the restraints.
Yeah. You're part of the restraint framework, mate.
I know.
And I just think that, like, we're just fed so much information these days, right? We're fed so much data, and I think a perfect example of you can be information rich but actually knowledge poor.
Yeah.
In my marriage, it comes down to politics and different things. Like Anna knows a lot about it, but it's actually knowledge poor, and I consume very specific information.
Yeah.
Try to get a broad spectrum, but not a huge amount of information on those topics, because it just sends you into despair, right?
Yeah.
And so I think a lot of this stuff, we're so often not seeing the opportunities in front of us as Aussies of what we do have every single day available, and we're not taking action. And there's a whole societal thing around kids and pressures and everything as well causing us to do that. And it just all builds up to working for 30 years and
then retiring, and that's
it.
Yeah. I think one of the traps that I see a lot of people fall into, and it talks to that, that cloud of information and expectation that you were just talking about there, is waiting until the time is right. And for me, that's it's like starting a family. Like, you can spend your life preparing every little detail before you have kids, but if you're waiting for every single thing to be perfectly in a row, you're never going to have kids. You do have to just at some point bite the bullet and start the family. And I think that's that's a similar thing here. Is you can, for sure, there's going to be some stuff that you should do, that you can do beforehand to prepare and to be really organised and to be as ready as possible. But ultimately, you just have to start investing, and that's today's topic. Is when, am I ready to invest? Is now the right time for me to invest?
The answer is no, but do it anyway. Enjoy the podcast. See ya. Yeah.
But before we get into that, I want to do barbecue chats. So
What do you got for me?
Yeah, one of my friends recently I heard talking about they're a first time refinancer, so they've just gone through the refinance process for the first time, changing banks after they've got a home loan, and they were really they're talking to another mutual friend of ours, and they were trying to say, don't do it. It's a huge risk. Like, do not refinance your loan. Like, you're better off just keeping it with one bank and paying it off. And I was like, what? Their mentality was they've had their loan for about 5 years. It was originally a 30-year loan term. They've been chipping away at it. They've been working really hard. Their lender refinanced it for 30 years, and they didn't realise that exactly until after the whole process had gone through. And now they've got this 30-year loan term, and they actually feel like they've been put completely back to the start. And so they were like, every time you refinance your loan, it resets the clock. And I was like, no.
No.
But
that's a little box in an application.
Yeah.
Fixed.
I was keen. I knew this would trigger you, so I was keen to hear your thoughts.
Look, you think of rate cycles as well, right? Like a little bit of a tangent. If you look at the rate cycles at the moment, Anna and I have not felt the change in rates.
Yep.
Because when we first bought our property, we kept our repayments up and actually increased it a bit as our income went up.
Yeah.
And this kind of ties into the reasons why I tie into the later discussion. But we were in a position where we were paying higher.
Yep.
I knew what assessment rates were like, and I was like, cool. Just this one little thing will knock 10 years off. So sweet.
Yep. Rates
went plummeting down. I got the low rate of 1.99 for 2 years, not 4 years at 2.1, which I should have done. That's another discussion. And then we were moving forward on the assumption that, hey, whatever happens, we'll keep our repayments up. We knocked another 15 years off our loan by doing that. But our loan term didn't change. And then the rates have kind of gone up and down over the last few years. I haven't felt it at all.
Yep.
I couldn't care less what my loan term is, but we're well ahead of it.
Yeah.
And the reality, I think, is like all it is just making sure as a broker that you're going, hey, do you want a cash flow win or do you want a real savings win?
Yeah.
Because we can perceive that, savings is your weekly, monthly, fortnightly repayments.
Yeah.
But the real savings is the interest rate.
Yeah.
But this impacts cash flow.
Yeah.
So all in all, there's just a lot in there. Like, absolutely, we want to, whenever we do a refinance it funded, like, we want to make sure that you're, like, we'll try and round down if we can with your consent. Like, if you're at 26 years and 3 months, it's like, hey, let's see if we can shave 3 months off here, get it there. Most of the time we're going up to the higher one, 27 years, and I'm like, just keep making the same repayments, manually increase it.
I think that's the thing, hey. It's like, it's a real onus on the lender or the broker to educate their client as to what playing around with loan term means on both sides, like shortening it or lengthening it.
Our aggregator would, if I don't comment every time, so if you're an investor, right, quite often you need servicing and you need some help with cash flow.
Yeah.
And Anna and I making some moves at the moment. We're probably going to extend our loan out to 30 years intentionally and keep our repayments the same because that shows servicing, but we know we can manage the cash flow, and it comes back to that affordability versus serviceability. Yeah. Where I think the opportunity is for brokers to be better, and Connective, our aggregator, and Licensee, they're the ones who told me to do this. They're like, you've got to comment and make sure that you disclose and have this conversation with your client, because you can keep doing this and clients never pay off their home loan, and there's been legal cases where that's turned out quite poorly. So you need to make sure that they're being educated. And I'm like, absolutely. Like, it's on every single thing we do to make sure that we're getting the loan terms exactly there. It's commented on 3 times in our process because we've got 40, 50 pieces of notes in like an application process to get it right. And I know in Bankland it probably didn't pay as much attention to that.
Yeah, I've had conversations with people before who were looking at either refinancing or topping up their loan for something, and they've said, does it change the loan term? And I have explained that that's something that's up to you, and there is a right time to do that, and you've got to figure out if it's right for you or not. And what I mean by that is what you just said. Like, if you're in a season of your life that is cash flow oriented, like if you're, say, having kids, one person stops working for a couple of years, maybe you need to stretch the money out as long as you possibly can to stay home. If that's the goal, then sometimes refinancing and having that loan term extended for a little bit actually eases the pressure during those years. But you can also do that. That doesn't mean you have to like reset the clock. You can schedule, you know, in 2 years when I go back to work, we put the repayments back to what they were when the income is there, and actually you can then continue paying it off at the rate you were before.
Yep.
And you know there's been no harm done. It's, you know, it's a matter of being really strict on yourself that paying off the loan is also a goal when I come out of this season of needing a cash flow sort of band-aid, if that makes sense.
Yeah, and I think part of the trap, because banks want to make money out of you, right? And I know if I go into my app right now, it will suggest that I lower the repayments.
Yeah.
And so I think it's just being aware what you can do, what you should do.
Yep.
But also just kind of back to my earlier comment about consuming information. It's not really healthy to look at your bank account every minute of the day constantly and ruminate on things and get that, oh man, I could have another $50 this month if I decrease my repayment.
Yeah.
Like, it's just not healthy. Take a step, take a breath. We spoke to Riley a few episodes ago about that 3-year goal. Get those 3-year goals in play, and that when you get the 3 and 10, I think just changes that intraday decision making that you're having to make. So yeah.
Agreed.
And look, if you are on the other side of that, just go, like most of these banks have apps. Just go request an increase.
Yeah.
Find a calculator
add
online.
a discretionary amount on top.
Yep.
For sure. I actually really love that my bank doesn't automatically reduce the payments. I don't know if that's across all banks or whether it's just mine, but I get the notice that says you can reduce your repayment but it doesn't.
No. Do you know what the trick is? What? If you manually set the payment, they don't.
Yeah. Oh, right. Maybe
yeah. So if you've ever manually gone in, you fall out of that rhythm. So yeah.
Yeah. Okay. Well, I have just always paid the same amount, and similar to yourself, the rate rises haven't affected me because I've always been paying at that higher rate.
Yeah. I knew I can service at 7.25 years ago. Like, it wasn't an issue. So I was trying to figure out what that was. And then I met people who actually had created wealth, and I realized that probably wasn't the best way. You save money, you don't multiply money by not paying a home loan off.
But I think the takeaway is that, yes, when you refinance, sometimes you've got the option to extend the loan term. You don't have to. If you are refinancing, you can talk to your lender or your broker, and you can really unpack, is there a benefit to changing the loan term? Should I be decreasing potentially the loan term? Like, maybe I'm way better off income-wise and we have no goals to, you know, do anything other than pay off the home loan. Maybe you actually, you know, look to reduce it or set your payments as such anyway. But there is, you do have the option. It isn't an automatic reset every single time you refinance is the takeaway, I think.
No, it's literally a data entry, manual decision by, if you haven't made it, by your banker or broker. Yeah. So absolutely.
Cool. Well, back to today's topic and your deep-seated fear of becoming a Henry.
You've given me a good idea for the thumbnail now.
I'm keen to hear where did the fear come from?
Yeah, it's interesting because we had this discussion on Monday, and then I spoke to another business owner who just didn't care on Monday Arvo, actually.
Yeah, okay.
And he was like, "Oh, I'll buy something in 5 years. I don't care. Rent's cheaper than buying a mortgage, so whatever." And I was like, well, that's not factually correct. Yeah. My mortgage is cheaper than your rent, not because of luck, because I spent 2 years busting my ass to buy a property. Yeah. And I think it's interesting seeing that, because I have grown up in and around business owners my entire life. And I have seen, I think, the fruit, so to speak, or the results of having a good income and a thriving business in the now, in the moment, and the cars they drive. But then I've also seen the other side of them trying to retire. Yeah. And to be frank, having a business that's not saleable. And I'm just keenly aware of the journey that Anna and I have had around money. We've been married for 13 years by the time this comes out. Wow. Yep. And she met me as a little commercial real estate cadet in North Brizzy. No, she met me when I was removing graffiti at council for a living.
I love your career path.
I met the Lord Mayor, side note, tangent. I met the Lord Mayor late last year at a lunch event, and I was regaling him with my career arc. And he's like, this is wild.
Yeah.
I was like, yeah. And the part that where we got onto it is he almost went into the Air Force cadets, or I think he did. He either did or didn't, can't quite remember. But I almost did as well. Almost went down to ADFA, and I was like, I dodged that and did civil engineering instead, and then bombed out after 6 months. So, but no, I've seen a lot of people put their hopes into selling a business, and a lot of the time they don't know the realities and the statistics and the facts behind that.
Yeah.
I'm not taking that for granted with Funded.
Yeah.
We're putting everything we can into this, and then some at times. And as much as brokers have a saleable asset, I just don't know what's going to happen in 20 years.
Yeah.
Right?
Yeah.
In,
and you can't
years.
rest on your laurels and leave that to be the only thing. Yeah.
And I think where we've been over the last kind of couple years, increasingly helping more investors get into the market, being a startup, moving out of hopefully that startup phase soon, if not already, doubling for the third time in a row. I think this year we've doubled year on year on year. I've been very intentional with discussions with my accountant about getting my financials ready to invest, because I want to take the opportunity as I earn more and more money, as the business does better, and we help more people, to be able to make sure that it's not about rewarding myself in the now.
Yeah.
I'm going to do that. I'm going to do that in little bits here and there. But like, I don't need a bigger house. I don't need a better car. I don't need all these bigger holidays here and there. We'll get those things anyway. They'll come.
Yeah.
We're going to reward ourselves. The things that matter to me is making sure that I'm not a burden in 40 years to my kids when I'm trying to retire and I can't. Anna and I have to live in their house or whatever. And that's,
I know, that's a scary thought, hey?
it's terrifying. And like, I hope we're close at the time and they're not going to let me live under a bridge. But you don't, like, I just don't want them to rely on that. But I also want to make sure that the standard of living that Anna and I are setting is something that we can maintain and do one or two holidays a year. And we're not turning around at 50 going, oh, crap, can we spend 10 years busting our ass buying 5 investment properties, crazy risk, over-leveraged, and just to get a chance at retirement?
Yep.
Like, I just don't want that for our lives. I want to really just compound over time. So, yeah, I'm just not taking anything for granted. And if I look at our story so far with Anna and I, I was transitioning out of, got married shortly after I transitioned out of commercial real estate / got fired, moved into bank finance, went on this crazy journey in banking, landed in home loans, loved it, dug deep. The tale's kind of written itself, but we decided we were going to buy a property. We decided simultaneously we were going to have kids and start saving towards buying a property in 2018. We got back from a giant UK trip, which is the part of the genesis of whiskey. It kind of launched the whole whiskey thing, really. It was like whiskey was there for a few years, but it amplified with the extra suitcase of whiskey I came back from Scotland with.
The start of the collection.
We were there to even the little bottles.
Yeah.
I was on point. I knew what I was allowed to bring back. But no, we went through this journey of we then couldn't have kids. We saved an insane amount for our first home. All of our friends were going out to Mango Hill, North Lakes, and we decided that we both worked in the city and didn't want to do that.
Yeah.
And so we went, hey, we're going to have to save more here to make this work. Very intentional. And I think we saved probably double, if not more, than most of our friends had to get into our house at the time. Made that move. And then was like, okay, we have been trying to have kids for 2 years. I guess we need to see a doctor. Yeah. And we didn't want to spend money till we had a home. Like, that was a stability thing for both of us. And we went through IVF, 40 to 60 grand roughly, maybe 80 with inflation. Insane journey there. Transitioned to a new bank to make more money to keep affording it. Finally delayed the dream of becoming a business owner, delayed that even further, went to another business, worked for someone else. That didn't work. Started the business with 15 grand left. Whole nother story there. And I was like, I feel like the clock's ticking for me to start compounding in property. and real estate and investing and taking my future seriously. We've built the foundation financially. We've got a lot of equity in our home. Now I need my income to catch up so I can start multiplying and leveraging. So
yeah, that's really interesting. I remember when I built my first house, I was only 19 when we bought that block of land, like so young. Built a house, and it was the kind of loan on the kind of income where we had like $5 spare, and I mean to do the driveway. Like we had no extra money. We from a serviceability perspective, we were only just making ends meet, so we had no way to even save. And I don't really know what the full plan was, if I'm honest, but I do know that at the time I had worked out that if we could struggle through the first few years of that we would be in a position to buy an investment property. And the plan, funnily enough, the plan was, we've recently had a chat about this, was upgrade our house and rent the old one out. That was the plan. Fast forward through a divorce later, that all fell away. And I had to save up to re-enter the market. And I was the same as you. Like, I really needed to be close to the city for a career at that point, which wasn't so important the first time round. And trying to save up the money that I needed for the house that I wanted just ended up, really, it was so unrealistic that every time I could save a little bit more, the house prices would go up a little bit more, and it would just become further out of reach every time. Yeah. So I ended up deciding that it would be better to settle for a house that is smaller and not as expensive as the one that we maybe wanted to, just to be in the market again. And that ended up being a really good decision, I think, for us.
I thought I was compromising from going from Stafford Heights to Aspley at the time. Now I'm like, man.
Yeah, like whatever.
The compromise is never as big long term. I know this is off topic, but shout out Jack and Priscilla. They did not want to live where they live now. And I was chatting to Jack the other day and made a joke about moving with all the tax stuff that's going on. And he's like, good luck getting Priscilla out of here.
She likes it?
Yeah, she loves her house. They've done a bunch of work to it. They love the location now. It's done really well for them. And I just think, like, we just let our expectations get in the way of us actually being happy so often. Yeah. To your point about, it's not settling. It's actually just making a smart decision.
Yeah. Well, where that lands me is I'm now similar to you. Like, I'm in the space where I'm now, again, ready to have a plan for investing and trying to figure out what that looks like as well.
Yeah, it's a funny time, right? There's a lot of noise, to our earlier comment.
Yeah.
And I don't feel like there's much fact.
Yeah.
And I think realistically when I make when I look at the world, we're being impacted more than a lot of businesses, right? Like, we have made a very, very specific decision to help home upgraders and investors and people buying property in general. That's kind of where we're at. Commercial property, everything there. But when it comes to the investors, it was like, hey, we have the ability to really, really help investors at a very high level. Let's dig deep into that and let these other things kind of over time come to the fore. And I look at the noise and everything from the negative gearing, all those changes that are happening, and I'm still pushing ahead in my investment goals because I'm like, we'll figure it out.
Yeah.
Like, I have enough reps in the bank over the last couple of years where I've seen much worse situations. Yeah. Kind of happen.
Yeah. We were talking about this the other day, and I think that, what we've seen come out in the budget, for sure it takes some of the shine off, some of the reasons for investing, but it doesn't take them all away. If there's 100 good things about something and you take one of them away, there's still 99 good things about it. So, it's interesting to...
Have you seen the experiment with the marshmallows and kids? Have you seen that?
Which one?
So there's an experiment with kids and marshmallows, and they say, hey, under this cup on your plate is a marshmallow. We're going to leave the room, come back when we
don't
get
need
back.
it.
Yeah, don't
Yeah.
need it. When we come back, if it's still there, we'll give you 2 more.
Right.
I don't know what the percentages are, but 99
They just eat
of
'em.
those kids eat them straight away.
Yeah.
I'm one of those kids.
Yeah,
I'm not waiting.
I know you are. Oh, I would not.
No.
Me, especially me as a child. I would, if someone told me not
Clara
to eat it,
would
I
be
would
yelling
never
at
eat
you,
it.
actually going, give me my other ones now. I'm not waiting.
Yeah. She knows what she wants.
Yeah. She'd follow them out going, well,
Yeah.
all right, I know why, I don't care about one.
That's exactly what investing is though, right?
Yeah.
It's like, I can't eat the marshmallow now,
Yeah.
but I'll have more later.
Yeah. And
wow.
we're just, like, we laugh at kids.
Yeah. We're doing the same thing,
Yeah.
just with real money.
Like it's,
Yeah.
The frontal cortex doesn't
Yeah.
develop. No, at least not in men. But yeah, I think part of the issue actually is also just a broken risk appetite in Australia, almost. You could argue greater than that, the West. But in again, another client, I said the other day, I said, mate, you're more comfortable adding a car loan to your budget than you are adding a home loan. And he's like, yeah, because that's less risk. I was like, how?
How? Yeah.
How?
Yeah.
Make that make sense. More comfortable splitting, a $50 Afterpay purchase into 4 payments.
Yeah.
I don't know how Afterpay works. Is that how it works? Paying for, that's my only reference from...
Well, it's funny. Like, you're asking these questions with whoever you're speaking to. I think that there is, like, practically, if you're wondering if it is the right time to invest in a property, whether it be residential, commercial, or what have you, if you're wondering if it is time to invest, or if you're wondering, is there too much risk, maybe that's one of the hesitations. There's probably some, like, practically some readiness questions that you can, either with the help of a broker or even on your own sometimes, just work through to get that peace of mind before you do it. We were just talking before about interest rate rises and how they, we're very fortunate in that we haven't actually felt in our lifestyle any impact from what's been going on in the last couple of years. I suppose you
fortunate, yes, but also we
deliberately
planned ahead.
fortunate.
Like
Yeah.
it's, it's not luck. It's
Yeah. Well, that I guess that makes my point then, is that if you're wondering, one of your hesitations is, but what if the interest rates keep going up and I can't afford an investment property? You could practically do the research to build in a few rate rises into what your repayments would look like and see at what point do rates have to rise before this actually becomes exit strategy material. Do you know what I mean? Like,
well,
what is the exit strategy?
I would answer it this. How many times do you speak to a home buyer, so a home upgrade or a first home buyer, you go, servicing says this, and they go, but I can afford that.
Yeah.
And then you chat to an investor and servicing says this, and they're like, but I can afford that.
Yeah. It's funny. It just flips. Hey.
Yeah.
Yeah.
And it's the same coping mechanisms in their head trying to protect themselves from perceived risk.
Yeah.
And all I'm going, well, the banks have built in a bunch of different metrics. So either you've got lifestyle decisions that you're making
that are different,
that are
from
stopping
the
you.
normal.
Yep. Well and truly above. Like I know when I do my needs versus wants exercise around this is a need, this is a want over 3 months of my transactions. It's an exercise I do monthly that Anna doesn't know about. I stopped bringing it up with her. It kept pointing back to me.
Because she was like, they're all wants, Alex.
Yeah. No, they're all you, Alex.
Your whole column, that's all wants.
She's like, do you want the girls to be naked? they're not needs. They're definitely needs. But if you do that exercise, you start to realize quickly, if I did it, if I gave one of my mates, shout out Mick, if I went to him, you do this exercise and I do this exercise, I guarantee him, I'll name him because we've had this argument. He's going to go, no, they're definitely needs. And I'm like, no, bro.
Yeah.
Like, you just don't. And there's things that are good, healthy things for kids to do. Like my girls, they do ballet and they do swimming on Thursdays. And I want them not to die in a pool, so they're going to keep doing swimming lessons. Anna and I both competed in swimming at very high levels. We really value it as a physical activity. And so I've sacrificed in my life things to afford it. The only time that I get food delivered is after a poor decisions episode.
Yeah.
That's because I'm like, I need a burrito.
Yeah.
I've had a whiskey. I
Fair.
need something.
Fair.
We just don't do it at home. And that's very different to what it used to be like pre-kids.
Yeah.
But we've had to recognize the sacrifices. The habits that got us to where we were are not going to get us to where we want to go. And it's all controllable. Facts are really, really give us a lot of clarity. And if you're constantly seeking after the clarity, it compounds. Just throwing all my buzz statements into that. But I just think at the end of the day, if we go, man, it's a risk to do that because it's too painful to sacrifice in our daily life. We work too damn hard, too many hours, week in and week out, to not be kind to our future selves and love on our future selves, which statistically we're going to get there. We're going to get to 80. We're going to get to 70.
Yeah, that's a good point. I suppose one of the other...
Did I actually answer your question on that one?
Yeah.
Yeah, cool. I just got ranty.
No, I know. I'm used to it. I think one of the other hesitations would be, and my mum and dad always had an investment property, and it was in my opinion, less than desirable suburb for quality tenants.
Can I guess?
No, I don't want to. I don't want to shame it. But it was.
Does it start with an M?
No, but it's very close to there. They had a string of terrible tenants. I remember every school holidays we'd be in there,
Do you know the
repainting, recarpeting.
Do you want to have a look at how much it's worth now?
Oh, I did it the other day, a lot.
We'll bleep this out.
Oh, I know. I don't know the number. I'd have to look it up on maps. I could find it if I needed to. But anyhow, I just remember there was periods of time where my dad would be in there ripping up carpet, and there was one time when the tenants left a hole in every single wall. There was just some shockers, really, really bad.
Never buy an investment property next to Caboolture
and
police station.
Anyway, I remember spending a lot of time there, which means fixing it up. While I was a kid, I was always there while he was doing it, and that would obviously translate into there was periods of time where he had it untenanted, so he could go and work on it in between because, something had happened. That would be a fear, right? Not so much, a bad tenant, but more periods of untenanted investment property means you're not deriving an income from it, which means you are 100% still, the loan doesn't go away just because the income goes away. So how do we overcome the fear of what if it's untenanted for a period of time?
Yeah. I think I'll just kind of preface this, right? I think there are two types of people that I meet. Ones who just need to get bigger needs, and they will make the lifestyle changes anyway. And others who just need to do a little bit of research and find more facts. And I think those two different risk profiles. First, they just need to run at it. They've already got the vision, but they just haven't taken the action.
Yeah.
The others, they just need to understand facts and kind of cut through the anxiety a little bit.
Yeah.
I think the flip, if I look at my marriage, we're definitely potentially two of those, but the opposite of what you'd think. I need the facts. And that's probably more of a childhood thing than anything. But those two people owning that investment property are going to approach it differently. And so what I see a lot of the time is, the people with facts, they we'll get the equity out. We'll try and build a bit of a buffer, a cash flow buffer out of the cash out that forms that. And they'll just want to be really clear on that sort of thing to make sure that they've got the cash buffer they've purchased with a little bit of extra left over for that. And that will help them float kind of the first few years while they're building up the confidence of that.
Yeah.
The others, they'll catch up. They'll figure it out. And I'm probably, hey, I'll get the facts and then I'll figure it out personally.
Yeah.
And then the underlying thing there is just getting the right insurance.
Yeah.
And so I think if you're looking at the gross payments that you need to make, so if you look at the total repayments plus the cost of running that property over the 12-month period of a year, divide that to 12 to get the monthly cost. minus the rental income, and let's just go 48 weeks a year. It's definitely not accurate. People are very, very desperate for places to live at the moment, in Brizzy especially. So you're not, like, the likelihood of having 4 weeks of vacancy is very low. But if you're looking at that gross amount, looking at it over 48 weeks, being really smart in your cash flow figures, you're going to, if you're putting that in, it's not even, can I afford this? That calculation's like, what do I actually need to put in that account each week, each month, each fortnight to keep this property afloat? Treat it like a single line item of a business. That's how we go. You're going to build up a buffer over time, just naturally. And then on...
like the rainy day buffer.
Yeah, you're going to get a couple months in there.
And you hope it doesn't rain, but if it does...
No.
No. You raise a good point, actually. Sorry to cut you off, but you mentioned just insurance before. I forget. Like, it just made me think a lot of first-time investors probably have never seen an investment insurance policy before, which is like different to your normal owner-occupied home insurance policy and covers different, types of risks that are associated only with investment properties. And one of those, you can get really good, companies that deliberately and specifically target insurance for investments. One of those things is, loss of rent. If it's an insured event, sometimes you're covered for a period of time for the actual rent loss while that repair work or whatever is done. Not always, but sometimes. But it would be, I suppose, one of the things that practically someone could do to overcome that fear would be, let's just actually have a look at the product disclosure statement for investment properties. Yeah,
look, I don't buy insurance without an insurance broker. I was actually on the phone to Darren today. And you and I have sold a huge amount of insurance in our careers. Yeah. I have literally won awards based on the amount of insurance I've sold. Like, it's the only award I won. Yeah. Some of us got Diamond Lender. Some of us had a successful bank lending career. Damn it. But it's like, I can't keep up with it anymore. I've got this whole other world in home loans that I'm busy over here.
Yeah. But you still need to have peace of mind that your customers are actually protected.
Yes.
Because it is risk.
100%. And so it's like, okay, we talk about the team around our clients a lot. Yeah. What can I do to make sure that they've got the right team? And Darren forms a huge part of that. Yeah. Nearly every investor I have at the moment is at 2 to 4 properties. Yeah. And it's like, I know, you're not getting the best deal and best coverage across those things. But are you opting into the right thing because you want to save money? And you're like, I don't want that. Whereas you could go over here and Darren's got a policy that automatically includes it at a similar cost. Yeah. And I firmly believe with insurance, more than most things, you pay for what you get. And the reason cheap insurers are cheap is because they fight tooth and nail not to pay out. And I've been on the other side of insurance claims before, and thankfully, touch wood, because this isn't, I've come out the other side of it pretty well. Yeah. It doesn't always work like that. I hear the horror stories of 3, 4, 5 years battling. Yeah. And so I think you're just being really, really wise with the insurance we get.
Really informed and wise,
Yeah. If it, like, it's not being a Karen, it's just being, like, ask the question. Yeah. Ask the extra question. It's not stupid.
And it's one of those times, I think, to sleep at night, you're like, it's obviously it's boring work to do due diligence with insurance, but like,
then outsource it.
Yeah, like, have the right team, get the right information, and not spend the entire time worrying about what you're going to do if so and so happens. Like, know what you're insured for.
Just to give you a quick analogy there, my car has something going on at the moment, right? I think it's something in the diff. It's really bugging me. It popped up last year after a service, so I took it back in. They found nothing. It popped up. Spoke to them. They said, no, it's tyre wear. Got the tyre sorted. And in the last month, it's gone much worse. Now, it's very well documented prior to the expiration of the warranty that it was brought up. So I'm not worried at all about that. So I've got facts there. I've gone real clear I've looked up, I've done some research, not just chat GPT or Clauded it. Like I've actually looked at, boringly, the Act.
Yeah.
And I've double checked, I've spoken to them, gotten feedback, and I was trying to get it into the mechanic like tomorrow. I was a mate of mine, shout out Chico, a lot of shout outs today. Chico popped in, had a look. He's a former AMG mechanic. He's like, yep, you need to get it back in and this is what you need to do, da-da-da-da. I spoke to him and I said, mate, I need it in tomorrow. Like, I drive this. It's my daily. I just don't want it to break down. And he's like, why the urgency? Like, all of a sudden, we can't get you into the 11th. And I said, well, I don't know about you, but I'm not wealthy enough to just lose a 40, 50 grand asset like that overnight because of this one little thing.
Yeah.
Like, who knows what corner I'm going around
Yeah.
and something breaks and I'm in a tree and it's gone.
Well, it could be more than the car that you're worrying about then.
Yeah. So I think quite often we don't realise the true impact, again, risk of, not having the right protection insurance on those assets that cost more than we can actually sometimes quantify.
Yeah.
So
the other thing I think expense-wise that would come up, or maybe this is more like a horror story that people get told and they have this second-hand fear rather than thinking of it the first time because the people who told the horror story didn't think about it the first time. But, unexpected repairs. Obviously, you would expect with a property, like especially if you've owned one before, there is going to be, maintenance that needs to be done. Things do wear and tear. Things do break down. You have to replace things. The same is going to be true for an investment property. And when you're the landlord, you're the person they call to sign the checks on those types of things. So it's certainly something to think about is what if the hot water system needed replacing or something like that. Me personally, practically what I would be doing to overcome that would be, as I'm working out, aligned with loan repayment, I'm working out also insurances and agent fees and all of the other expenses that I know I'm going to have to pay. I would consider an amount of money, like a reasonable amount of money in my annual expenses, as I will absolutely have to pay this, even though I don't. And if I don't, it works like you said before, right? We just roll it over and we keep building on it, and it's there for if the roof blows off or something really bad happens. But that's how I would be approaching it. Like, keen to hear what you do to give comfort.
We're going insurance analogy heavy today. When I had my first car crash, it was actually at the end of Darwin Street, which is at the end of my street now. I ran up the back of someone.
Don't they say that? Or like most crashes happen like
no,
really
I didn't live there at the time.
Oh, you did
yeah.
that? Oh, right.
Yeah, it just clicked. We literally did a school tour.
Yeah,
just where I had the crash the other week. I just doxed myself. It's not going to be the last time. I remember I didn't have many commitments at the time, right? Like I was, 19. I'd had the car.
Yeah, you and I had very different versions of 19.
Yeah.
As we're finding out.
Yes.
But I'll play along.
Mine worked. It shouldn't have, but it did.
Yeah, somehow you landed on your feet.
Yeah. Goodness. I waited for, Anna waited for her husband's frontal cortex to develop.
Yeah.
Sorry. It's such a good cut. Gosh. No, I had a crash. I was trying to change songs or something, looked up, and there was just this Honda Jazz, and the most fabulous man was driving in the world was driving that car. It just was in a whole tizzy. It was this whole thing. I was just like, bro, you're like 30. Go, like, calm down. He was like, oh my goodness. I didn't have savings at the time. Yeah. And what I had to do is I just sunk my whole paycheck into my excess when I went to pick up my car. But I lived at home, like $1,000, whatever.
You mean you couldn't go out that weekend or something?
I probably found a way. I probably raided a coin jar.
Probably still did.
Yeah. Probably called up some mates who were DJs to try and get into GPO. Had to get there really early to get in free though. But no, it was just this like
we didn't know Chris Arnett at that point. No. Maybe
the Hulk. This guy turned into a Hulk. It just threw me across the room. Oh goodness! I'm going to send this clip to. I've got a couple clips to send people. Yeah. Gosh, no one's going to get that reference apart from the three of us. I just sunk that all in, and you just don't sometimes have that now. Like, that's not realistic.
Yeah, well,
right?
when you got your own property
Yeah.
and kids and everything else, like, you can't just sink a whole paycheck into something. You've got to
slowly.
You've got to be really
accrue
pragmatic in the
Yeah.
planning stages and really disciplined, I think, to actually follow through on something that may not ever be needed, but is your, personal insurance.
It's not even for the practical side of things. It's just for the peace of mind. And I think good stewardship, which we talk about often, is just taking that third eye view of like, hey, what is the best thing that I can do to manage this money that's coming out of my day-to-day labor, where I'm trading time for money? What is the best thing I can do out of that?
Yeah.
And there's a lot of opportunity, I think, that we don't see. Like, your plan there is perfect. And if you're worried, just divide it by, like, account for 6 weeks vacancy every year.
Yeah.
Because the likelihood, if you can't afford it, what the property manager is going to do, or not even if you can't afford it, what the property manager is probably going to do is just not pass on the rent. Like, they're going to take it out of the rent they collect that month. It's
Which
the
means
easiest
you're
way.
going to have to
Yeah, you've got to float a
the-
month anyway, or whatever that ends up being. So I think just having that buffer, and it's incredible as well. Like, clients are like, oh my goodness, I'm so worried. And then they just get through the month. They're like, oh, that wasn't that hard.
Yeah.
Like, it's funny how reps just do it.
Yeah.
Or just give you that assurance that you can do it. And Ryan Gilbank, great mate of mine, is coming on the podcast in about a month or so. He often says that, like, we could have bought a much bigger commercial property for our business, his business, when they first bought it, but he didn't have the reps of risk. Now he looks back and going, I would have afforded that easily. And so I'm constantly, for me personally, looking at what is the balance between just being balls to the wall, like YOLO, let's get all the debt, do all the things, and what is actually managing things wisely. Like, there is a tension in between those things, but how can we stretch that extra 20% more and actually grow a little bit out of it, take that next step and move into whatever you're wanting to work towards? Because for me, it's so much easier to have a bank account that we transfer a little bit of money in each month, top up, cover everything. It's there. I'm never going to be worried about that investment not having tenants.
I think the sad distilled version of this conversation is that all of the activities to get really comfortable with investing are, like, really boring. Like, one, you got to really calculate.
Or stressfully confronting.
Yeah. You got to calculate your repayments and add a buffer in there, which is not a glamorous exercise, but one that I think that would actually probably do the inverse. It would give you so much more confidence, because you realize actually how much rates can rise before you break the bank.
Yep.
You've got insurance PDFs. Obviously, that's a boring day reading those, but or you get someone like the wonderful Darren, who is a brilliant character, to explain it to you really beautifully, which would be a far more interesting way of doing it. And then obviously your budgeting. You know, you've got to really sit down with the people involved in purchasing the property and work out what the budget looks like and how and commit to how much you're going to put aside for various things based on what level of comfort you do want to have.
Yeah, I just think for me it always comes back to what are your needs, what are your wants, and if you've bought your first home, they're probably out of whack. Your needs are probably a little bit higher with the repayments, but over time it's going to stabilise if you don't keep trying to keep up with the Joneses. Like, it is a long-term gain by sacrificing that cash flow.
Yeah.
Where I think we're kind of just need to move a little bit into a bit more is just understanding the stages of life we're in and making sure we're not cutting our nose off now to spite our face later.
Yeah.
Like, I think I got that analogy right, but my thing has kind of been a gradual growth into getting ready to invest. And even now the plan's pivoted slightly. Like, we're always resi. Now we're pivoting slightly.
Yeah.
And that's not a response to tax. It's part of the algorithm of the decision. But that is more of a kind of, hey, we think we're actually in a better position to make this move into commercial. Whole nother discussion. But I think from my perspective, like, we went through these life journeys. We tried to steward what we had, despite COVID making me very familiar with Ben and Jerry's via Uber Eats, a whole nother discussion. I was dutifully working towards how can we keep ourselves positioned to invest in property when the time is right. And now it's just going, hey, this is a goal of 4, 5, 6 years, 7 years really to invest into property. I've had to get my foundation right, but I've been very intentional about, okay, what's the next move? What's the next move? What's the next move? What's the next discussion with the accountant? Okay, the accountant's give me this. How can we action it? Let's not waste every single block that comes along our way. And it's not so boring when you're kind of taking that journey as opposed to, I'm just going to study a PDS tonight.
Yeah.
Like, yeah. I think that kind of, for me, it's like, okay, I need to get clarity now, update some figures, borrowing capacity, tick. I know where the equity position is. Okay, what's next? Well, I need to get the structure. Like, it's just this step-by-step process. And we talk a lot about momentum. Yeah. And I think quite often where I see a lot of brokers and, buyers agents and other professionals go wrong is they don't honour people's momentum and they don't see the effort it's taken to get to that point.
Yeah.
And I think because
that's not started at the first conversation you've had with them. It's been months, years before that. Yeah. Potentially longer. Yeah.
I chat to friends after 20 million conversations on the same topic for 3 years.
Yeah.
It's just they needed momentum in their relationship to get to that. Would they be in a better position sometimes if they had have acted 3 years ago? Sure, but you don't know what's going on there.
Yeah.
If people are taking the time to chat to you, you got to honour that momentum onwards. And now that we're honouring our own momentum as a couple, I'm not going to let anyone get in the way of that either. That's the other thing. Like, I'm not... we've had much worse times in our career, let alone this business, in terms of a budget or whatever government of the day changing their minds. It doesn't change the fact that my income is there and healthy and okay. Yeah. So I'm not going to let a war on the other side of the world.
Yeah. It's making me think there's some things that are within your control. There's a lot of things that are outside of your control with how things go. One of those things largely is you can choose your property wisely, but you can't choose how the price increases over time. We've seen huge price increases in properties over the last few years, but what if I was to buy now and it stops and it just stays at the same value for the next 10 years? That would obviously feel somewhat deflating, that you weren't getting that instant win of property value increasing. But there's other benefits of owning an investment property, right? Like, it's still a worthwhile investment.
We've got to be careful we don't jump into the property advisor's role on this chat. But when I bought our first house in 2019, the market was dead. Yeah. It was flat. And obviously 12 months later, it was starting to rocket, right?
Yeah.
I think 10 years is probably, 5 years, if it did nothing. Yeah. 10 years, I'm a little bit worried. You probably didn't get the right advice when you bought initially, right? And so I think that's a real good discussion with a financial planner to have and go, hey, do I need to cut here and go elsewhere? Because if your property's not done anything for 10 years, I guarantee elsewhere in Australia stuff has. Yeah. So just a thought there about getting the right advice. It
comes back to the team, doesn't it? Everything sort of comes back to this, having the right team around you.
But when we bought our place in 2019, I was like, okay, we need housing security right now. We need a house that we can pay off. And, I was taught growing up by my dad that property doubled every 7 to 10 years. I was laughing at him in 2019 going, sure, mate, how's this Queensland going to fix itself? Eggs on my face now. Where I think it's just kind of being practical, I was like, okay, I need to save this next deposit. I need to save another 50 grand to make this happen, if not a little bit more, because it's an investment. I need more stamp duty. Haven't got as many help. Got to figure this out. That was kind of the thing that I was at. And at the same time, I'm like, hey, if I pay this off over the next 30 years, buy an investment property, it doubles a couple times over that period. I keep putting money into super, I'm going to be better off than my grandparents in their retirement. Yeah. And so it's just about going, how can I make the small little increments now? And again, 5 years, if it does nothing over 3-4 years, I saw too many people in 2018-19 exiting their investment properties because they're like...
It's not doing anything.
It's not doing anything. It's not doing anything. I've just got this cash flow and tax. They had all bought brand new properties, newly built properties, which is very interesting considering the negative gearing changes. Yeah. They'd all bought brand new properties. the tax depreciation. So do you know what that is? The schedule of depreciation of new assets that had gone into the brand new build had decreased and gone at year 5, year 6.
Yeah.
Property hadn't valued up at all or changed. And they're going, now I'm just sucking money, cash flow. And what's the purpose?
Yeah, now it's just costing me. Yeah.
If they had to wait another 3 years, there's the double.
Yeah.
And so I don't think sometimes it's not always a linear. Nothing is rarely from like the bottom of a chart to the top.
Yeah.
It's always up, down, slow to the side, up. You know, like life's not linearly up. It's up and down. So I just think it's actually going, okay, did I get the right advice? Did I buy this for the right reasons? Did I buy for capital growth or did I buy for tax?
Yeah.
Is this the best decision to keep sticking in? And do I just need to wait for the other side of this? In 10 years' time, will I be laughing? And so thankful I held on. And it's just not making a reaction.
It's so funny. I that first house that I built in, what was it? It would have been 2019.
09.
09.
We're old, man.
2019.
I was like, you said 19. I was like, we're the same age.
09. Oh my goodness.
Yeah, I do that as well.
Oh,
I quote
yuck.
2016. I'm like, oh no, that was
That's
06.
actually so upsetting.
Yeah.
Anyway, I think we had that house for 5 years. And like I said, we built it with every penny that we had. But it was a good big house on a big block, very, very far away from the city. But a really good house. Like it had like 3 lounge rooms and 4 bedrooms. Like it was massive. But we put every dollar that we could into it. And when I didn't sell it because I wanted to get out of the market, I was actually very upset about that. We obviously sold it because of a breakup in relationship. So it had to be done. It was something that had to happen. But I think I felt at the time so grateful that it had increased even just enough that we were like almost breaking even kind of thing. And in 5 years.
You weren't having to wear the agent costs.
Exactly. We could pay the fees out of it and we could pretty much just walk away, dust our hands of that era and move on without residual debt or anything like that.
Just on that, to jump in quickly, I think we didn't kind of go into this enough in Riley's episode. One of the things I wanted to ask him was about P&I versus interest only, which we kind of covered.
Yeah.
But I made this statement that like, I don't believe in the optimal thing because it kind of ignores risk. There's a theory and I don't see financial planners. I know they've got their actual facts, financial planners, but I see more buyer's agents saying this than anyone else. There's a theory that if you go interest only on all your properties, it's better for cash flow. And then after 30 years, you sell everything, reduce all the debt.
Yeah.
They're ignoring the risk and the reality of actually not reducing debt over time. And I think to your point, you guys were P&I.
Yeah.
Even if it had done not that 20 grand, by being P&I, you pay the bulk of the interest at the start of the loan and you start getting closer to that event of actually getting profitable on it.
Yeah.
So if you're worried about your property not growing in value, don't do interest only.
Yeah, interest only is probly not a good one. Yeah, you do need to be actually actively reducing the debt.
And then it's just forced savings.
Yeah. Well, like I said, we walked away very happy to just be dusting our hands of it. And now, so what would that have been then if it was, so it would have been like 2004. No, 2014. Sorry, I'm so bad with this. Like when we sold, 2014, 2015, something
I don't know
like
why
that.
you're looking at me. I don't know.
Because you're better at maths than me, obviously.
How many years did you own it?
5.
Yeah, 2014.
Yes, and so...
You did better at school than I did, mate.
Yeah, I know.
It scares a lot of people, including my wife.
We are now like over 10 years past the sale date, right? This is where I'm trying to draw it from. So I'm just saying if I still owned that property, if I never sold it at that time, it just sold. No. It just sold like in April.
Do we need some sort of employee assistance program?
Oh my goodness, we do. We really, really do. Because like I said, it's so far out of Brisbane. And at the time, the fact that I didn't have a debt after we got rid of it.
Bar, right?
It's
where is it? Narangba?
No. Like close to Woodford.
Oh wow.
Yeah. Very far away.
Yeah. What did it cost you? $235 to buy and build?
$350 all in for like for a massive house. And that's what I mean. We did it because we couldn't afford that kind of house close to the city. So we went further out so that because we wanted wanted to have a family. So it served its purpose actually very well, but ended up being that at the time that we sold, it was so far away.
I'll make the jokes after the episode.
If I had hung onto that property for another
worth?
10 years, like it just sold for over 1.2, like way out there, because it was a good bones house. Like it was a very smart, and we strategically did that. We spent every dollar that we could trying to get like the nicest house we could, because we wanted to stay there for a long time. And the plan, do you know what's so funny is so the point of my story is the plan originally was we'll stay in this house for like 15 years.
Yeah.
It's now about that 15-year mark, and it was just sold for 1.2, which is just wild. I would never have anticipated that. And in all my calculations,
that's triple.
I had never considered
quadruple.
I had never considered that the property would be worth that much money.
Yep.
So yeah, it goes to show like 5 years can do nothing, and then 10 years can rapidly increase it.
Yeah. I mean you just don't know what's around the corner sometimes, and I think. I think about Warren Buffett as much as I think about the Roman Empire. I wish that was a joke. But I think there's a crazy statistic that he earned 60 of his $68 billion fortune after the age of 70.
Yeah, I think I've read something like that actually.
It's in Morgan Housel's book is the first time I came across it.
Yeah.
And
there's a lot of people that have done similar things there. Like a lot of that happens.
So
like they work for 50 years, can't do anything, and then it all just kicks off.
Yeah. Well, I've got a mate, Will, who lives down in Melbourne. He's a year younger than my dad, and so he's very young. He was like, he is in the point where all of his hard work is compounding. And I think right now in, 20s, 30s, 40s, especially, guys who aren't having kids, we have a bit of energy to burn, but that's not going to be around forever. And so for me, I'm like, well, what's the foundation I can make with all the energy and time that I have now? Let's not sacrifice the family on the altar of success, because that's a fake thing to try and chase after. Let's put really clear boundaries that Anna and I agree with. And most of the time it's after the family's in bed is when I make up the time. Not on purpose, it just kind of happens. And so it's like, okay, what is the compromises we can make that Anna and I dutifully agree on together? But also, how can I use the energy I have now to make sure that we're going to get something that can actually compound over time?
Yeah.
I'm not talking about like being worth 70, 80, 100 billion, whatever.
Yeah.
Like he will end up being worth.
Just something to hand down to the kids would be nice.
I mean, let's pass grade,
Yeah.
live in my own house that's paid off,
Yeah.
and have enough to live on and go on a holiday
Yeah.
once a year. Obviously, I want more, but you're kind of sitting in a little bit of ignorance if you're not making changes or being intentional about it now.
Colin made a really good point in his episode that if you just do the simple maths on how much super you're going to have at their retirement, like it's not going to last very long. You have to have another strategy to work alongside super.
Yeah. Yeah. Look, one of the cool things, I'm glad you brought up Colin, because he is, he's someone who retired his parents. The amount of energy he is putting into creating wealth, the amount of effort he put into his career in his 20s and 30s to buy more property, he would make career moves and negotiations based on a conversation he had with his broker.
Yeah.
So he'd go to his broker, what do I need to earn to get this next property? He'd go back to his boss and go, I'm kicking these goals and I want this income. And the boss would go, well, yes, or hit this, and he'd hit it and he'd go back, go, where's it? And they'd go, no. And so he'd change jobs.
Yeah.
It would always be about that. And that's a man who,
but the way you are on the
mid-40s.
map is always the broker.
Yeah. Current location. But it's just like you need to be really, really intentional. And he is, I love him to bits. He's way more intense and intentional than anyone else I know. But the fruit is there. He retired his parents.
Yeah.
He was able to help them get into a position where they didn't have to work. And he's got one child. It's not a legacy thing for him anymore. Like his daughter, Ava, is going to be okay.
Yeah.
They're going to take care of her financially regardless. For him, it's actually just being, I can be crazy generous now.
Yeah.
And there's so many layers to it. And there's nothing he's not missing out on in life, but he's been very intentional to build a foundation that's going to compound on. And I think I'm excited, like, for Anna and I, because we've been varying levels of intentional over the years, but it's always going, okay, what's next financially, without losing the joy in the moment that we're in.
Yeah.
And like IVF taught us, or at least taught me that. Like, I was like, I don't want to just survive this.
Yeah.
What if we never have kids? Like, we've got to keep enjoying life somehow. This can't define us. And we've got Roni Clara, thankfully. Like, that's awesome. But I don't want to take any time for granted at all. And it feels like we are a lot. And then it's like, okay, well, I need a new car.
Yeah.
And suddenly we're just like this far away from buying an investment property when we were right there, because we've just shot ourselves in the foot with a want.
Yeah. Yeah, it's a fine balance, isn't it?
A bad weekend of dopamine hunting.
Yeah.
Yeah. And I say that as a guy who went out and got a 60 grand pay rise, and shortly after bought a Mustang.
Yes,
So
you do.
I'm experienced. Yeah. It's not coming into this blindly. And I've had to spend time unpacking and fixing that and learning new habits. So, but you know what they say? You can out-earn your bad mistakes. No, you can't. You can't. You definitely can't. And so I think with all that kind of being said, I think the reality is there's always going to be a noise. There's always going to be a ghoul in the basement clanking around that's going to terrify you from going into a place that you've probably actually been before, right? Like, let's be honest, I grew up terrified of the dark. Well, I did. I'd been outside many times. I'd braved the dark many, many times to take the bins out. Did I keep sprinting? Yes. And I think quite often we're looking at decisions that seem big, and we're letting outside noise scare us away from that. But we've actually walked the path to get loans before. We understand that process. We've walked the journey. And I think the decision kind of comes down to, are you going to let, I'm thinking of someone in particular, some dweeb on ABC, keep speaking into your ear, talking rubbish, stop you from taking steps? Are you going to let someone in a office in America make war decisions, stopping you from taking care of your own finances over the next 20, 30 years?
Yeah.
I'm not. I'm just not. I don't care. I'm going to look at my facts. I'm going to look at the figures. I'm going to let clarity compound. And I think we're just going to keep moving and making decisions. And we're kind of working on something at the moment. So I'm excited because I might learn to be a vlogger out of that.
I'm excited.
Yeah. And just kind of document a little bit of that journey. And the first thing that clarity started was I actually made a presentation for Anna to go through and show her what I was planning and what I was thinking and get her on the same page. And again, that clarity piece, it's so important. I'm just not going to let people overseas, around the world, down in Canberra, stop me from achieving my goals and actually using the money coming out of the business. So with all that being said, thank you for joining us here at Finance But Neat. Yeah, this has been a fun episode. We're going to kind of wrapping up a bit of an investment arc that we've been going through. We've got another big one kind of coming through, distilled episode in 2 weeks, where I kind of break down a lot of the stuff. But I think just have a look at your momentum, honor it a little bit, understand where you're at, what big life stages are coming through, what's happening with childcare, all that, school fees, everything over the next few years. And is there a window to get into the market now where the cash flow makes sense that you're going to be able to walk through over the next few years and get clarity on that? So if you liked this, share it around, subscribe, do all that good stuff. I don't know what I'm meant to say at the end of these, but thanks for tuning in.